But today I was telling everybody I was overall bearish, or I wanted to see price come down to this low right here. I was telling everybody I want to see this low hit. But what did you end up seeing happening? My full target didn't get hit, but one of my TPs, which was a swing point along the way, it got hit. And that's where price ended up reversing and going the other way. And that's the reason that we take profits at our swing points along the way, because a swing point along the way could trigger a liquidity sweep, which it did here. It stopped here
Mm.
and reversed and went the other way instead of ultimately hitting the one that I went so wanted. So it's like it did go 3/4 of the way where I wanted it to, but I would be a fool to then let it go 3/4 of the way. And because it didn't go the full way, I just let it turn around and I take a loss on the position. So it's like that's where
That's
your
about where did you get in?
um you saying on it, I didn't get in on this. This was my what I was wanting to see. Like what I wanted to see was the market go down, but I didn't see it how I wanted it to go down. So like,
Was
but I
you
was
you just
just
analyzing it or something?
Yeah, I was just showing, but that was just me giving you an annotation of how, like, of how why you using the why you could use multiple TPs, but a lot of times when you starting out, it really be better to focus on one because you can overcomplicate it at the beginning when you can just keep it simple. And it's like, because like a version of keeping it simple is this London low right here. This was like probably this was the best trade. Like this wasn't what I was initially looking for, but it was the best trade. And what happened was we came down and we swept this London low. And after we sweep this London low, our eyes go to London high. And then we went, we got a market structure shift. We got a market structure shift here on the 5 minute where we went above this high with some displacement. And displacement means like you go above like an old high or something with strength and momentum. So basically
Okay.
a strong candle. You see how this candle is stronger than any of the other candles?
Yeah.
That's one of the things that will let you know, like, okay, this is a real deal market structure shift. I see strength above this old high, creating a new high. And then after that, you see we end up
Tap
tapping
into
back
it. Yeah.
down into the fair value gap. And then we end up going to London high. So in this case, a beginner trader, it would be a much easier thing trade for you to manage to just be like, okay, once I get in, once we hit that London high, I'm out. Like for a more advanced trader, they could be like, okay, once I get in here, I want to take profit at this level, then this swing high, then that one. But that's putting more on you when it's levels basically. It's phases. You want to go through getting in and getting out and a lot of times you want to be able to have to ask the question or think like, damn, why is this going on? Like a lot of my trades I'm getting in, they reversing a little bit before they hit the TP. Then that's when you want to go and implement that because you might not have a problem with
Yeah.
with that. And like some everybody have different needs when it comes to that because some traders are more scared being in the trade and they want to get out the trade as quick as they can. So they might have TPs along the way. Then you got other traders who are more comfortable staying in their position till the full TP is hit, which is the easiest way. But
Mhm. You explained it perfectly though. You
but
keeping it
what
open. You keeping it open. Like the choice is yours.
yeah. Yeah. Yeah, but that's what everything like that's why I tell people like how I do it is everything is gonna be on you. It's not like I can tell you how I do it, but you have to figure out how what's gonna work for you and your risk tolerance, and you know how your mind work. Like you will know once you start taking trades, you'll know if you can stay in the full position. You'll know you'll start asking the questions like, hey. I think I might need the where do I know when I can take profits along the way? You'll start asking those, you'll start asking the questions that you need in order to help you develop. And then, that's when we'll start working on that. And like it's something else. Let's see, do I hope I got a picture of it. But if anybody had any other questions, something before I try to find this picture, I hope I got it because it'll make this a lot simpler if I got. And I probably don't got it on here. Okay, there we go. And yesterday, did you get a better understanding of the swing lows and the swing highs?
Who that me?
Yeah,
Yeah, I believe so.
because okay, so I want to go over this with you, and you just if it's taking you too fast, let me know. But I feel like you would pretty much get this pretty easy. But we have like you might be, I think you asked the question like how do you know where the market is going, or how do you know where the market wants to go or wants to move to. And what we understand about the market, well, I want to let Omar, because out there Omar Z is somebody, or Gary, anybody explain this picture from it, because I know they the ones made it simple.
What? Explain the
The
internal, the external?
Yeah.
Yeah, I hear you with that lingo all the time.
Shit. Internal, external. I mean, I just look at it like this. External are your swing points, and internal are your fair value gaps. That right there was what
Ex-
summed it up for
Bro,
me.
you said
I'm tri-
external is your swing points and internal for the
Swing,
bad guys.
swing highs and lows is external, and your
Okay.
internal is your fair value gaps or imbalances, however you look at them.
Let's see. Can I get this picture on here?
Let me see.
Hopefully
Okay.
it's
I heard that one time. I ain't need to look at nothing else about that
yeah.
shit.
ERL, IRL.
Yeah, and I got a diagram. Let's see. What's today's
Okay.
date?
Oh, they just got it in the line in the bar.
Yeah, but I'm gonna break it down if I can find the picture I just
Hey,
yeah.
y'all had the struggle, so somebody else can walk.
Yeah.
Man, I was
But
still looking.
you said what?
I said I was still looking.
I was gonna I could go back to that one, but I was gonna show you this one because it had this one got the ER with it actually, like the definition for it on it.
Okay.
So you can like external, you got it right there. External range liquidity is your swing highs and swing lows. Internal range liquidity are your fair value gaps. And I can go back to that other one if you need if you want to see that other one.
Yeah, I'm looking at the line. I mean, I'm looking at the bar.
But
Let me
look at
see.
but how we interpret the market, or what helps us understand the market is we know that the market, like how I told you in other lessons, the market is always looking for liquidity. And it's two major types of liquidity. You have external range liquidity and you have internal range liquidity. And your swing highs and swing lows will be your external range liquidity.
Okay.
And your fair value gaps will be your internal. So what price does is it moves from, like you see, we got this external here, it moves from internal to external. And then you see after we take out this external, what do? We go down and we go to internal, which is a fair value gap.
Yeah.
So like price then after we go to internal, it's looking for external, then it goes to internal and looks for external. So that's all the market is doing. It's either looking for a swing low or swing high, or it's looking for a fair value gap. If you're inside of a fair value gap, then it's looking for a swing low or swing high. If you take out a swing high or swing low and you get a liquidity sweep, price is then looking for a fair value gap. And like if you look at this bar chart right here, you see price starts out tapping into internal. So if we start off tapping into a fair value gap, where is price going after we tap into that fair value gap?
You said after we tap into a fair value gap, it's gonna go back to a swing high or swing low.
Yeah, we got this swing high here. Then we come and take out this swing high right there.
Okay,
So
okay.
after price takes out this swing high, we create a new swing high. And then
Yeah.
once we taking out that swing high, we then come back and tap into a fair value gap right here, this fair value gap.
Yeah, yeah, yeah.
And once we tap into this fair value gap, price is going to do the same thing. It's going to go back up, take out a swing high, which it did here. And this price is
Mhm.
going to go. And then as it goes up, it's going to come back, tap into another fair value gap. And then it's going to go higher, take out old swing highs, swing lows. It's going to take out swing highs, if we bullish. And if we bearish, it's going to take out swing lows. So like you
Okay.
see, and then we take out this swing high, price go up, pull back into a fair value gap. So like this with this line chart represents, and that's what we're anticipating. When price goes up and then it pulls back into a fair value gap, we understand that when price pulls back into a fair value gap, that after it does that, it should then be going to, a swing high or swing low. So we use those fair value gaps as an opportunity to get in, anticipating that we know where the market is about to go next.
Yeah. The market move, internal,
It makes sense.
external.
And you kind of been saying like hinting at it, but this make it make sense. You just couldn't
Yeah,
use them words, so you were just trying to go in order.
yeah. So it's like, and I can show you an example on like I can show you.
Cheers. You could show the one from?
You said what? Say it again.
No, I was gonna say you could show the one from today.
Yeah, I'm gonna show on
Didn't
the.
we tap into that? Was that a 4 hour, 1 hour bears after that sweep on London?
Yeah, I'm gonna get you to point me to where they said after I
Look
show
at
this
that
look.
bullshit there.
Nah, I'm just saying, where is it? Which nigga hate that.
Get
Look
you.
at you.
But you see, right? Is this where I want to be? I don't know if this is where I want to be because this the okay. You see price right here. You see price. You see how price taps into this fair value gap right here. We have a fair value gap here, and you see
Yeah.
how this price taps into it.
Yeah.
And then after price taps into this is internal liquidity, which is a fair value gap. Where are we expecting it to go after we tap into this fair value gap?
We expecting we expecting to go to the swing point.
Yeah, in this case, we expecting, and also you want to use your context with this because it's gonna matter if you bullish or if you bearish. And in this case, we got a liquidity sweep. We got a liquidity sweep here. And then, we got a market structure shift. So this is us tapping back into this fair value gap, which is bullish because, we got that market structure shift changing the
Okay.
trend. So now when we tap into this fair value gap, which external range liquidity are you looking for it to take out? Is it that swing high or that swing low?
We're looking to take out. Now we're looking to take out the swing high.
Yeah. So and after we take out this swing high, where do
Oh, let me
we
find it before you go.
you said what?
I'm trying to find it myself before you. Where you point the swing high out.
Right here.
Okay, okay, okay. I
And
don't know
after
why. I don't know why I'm looking at.
What?
Them two right there. You got a line drawn to right into the right.
Uh,
Yeah, them two.
I don't know why I had that line drawn to that. But if you was looking at this one right here, it wouldn't have been wrong to look at this one either. Like this swing high here, it wouldn't have been wrong to look at that either. Cause like they all
Okay,
one.
all right. I'm listening. I'm listening. Go.
But after we take out this swing high, which is external, where are we expecting price to go to now?
Tap back into the fair value gap
And you see how price does that here.
right there. Yeah.
And then
Okay.
so like now we see price tap back into there. And once it taps back into here, then now we're looking for it to go to external again, which it did
Right
here.
there. Yeah.
So when price is doing this, that's what we call the market moving efficient. Because when the market is doing that, it's not hard for us to get in here and to flow with the market and tell what the market is going to do. You do have times where the market goes off script and it does do a little crazy stuff, but if you can if you can find the times where the market is trending and it's going from internal to external, or when it's going from fair value gaps to swing highs and swing lows, those are the times that you will thrive or that you will do good. And like also you can even use context for when it's not going to when it's not going to work. Like right here, we tapped into this fair value gap. We took out external, then price decided to go higher. Price decided to go higher right here, but we tapped into this fair value gap after we went higher. But what did we see? We couldn't, we couldn't even make it to external again. We went
Yeah.
to internal, but we could not make it to this external. So now that's a sign like, hey, we ain't making it to external. Then, so now, now I'm paying attention, like, okay, what's going on? And since we didn't make it to that external and price kind of stopped and stalled out, what do we end up seeing? We end up seeing a sweep of this high, then price started, going down. So it's like you can kind of see at times, when it's not going to work. But overall, if you can look for those times where the market is going from that internal to external, you will do good. Like that's how the market moves. So like when you was asking, or you asking those things, that's how we look at the market to move, and how we can tell if it's moving efficiently or when we really in tune with the market. And like here go another example, because like you can drop down time frames also to see like we got this initial liquidity sweep right here, where if you need to see, we took
So,
out London low over here.
yeah.
So after we took out London low, now we're looking for a market structure shift, which we got this market structure shift here. And after we got this market structure shift, we then tapped into this
The
fair
value
value
gap.
gap, in which is internal. Now we went from internal, and then we took out external. And then probably if you would have entered on this internal
Ooh.
expecting external to get taken out, now you in this trade, and now you making profit, and you can ride the trend, and then price goes up, pulls back. It didn't quite pull back to a fair value gap here, but it pulls back, takes out external. And after it takes out external right there, where do it come back to? Internal. Then it takes out external, which is a swing high. And then price just kind of then runs up and goes to its target. So it's like that's how, like when you ask like, okay, how the market move, that's what we're looking for. That's how we know that price is really moving good. Because it's essentially like that line thing that that you constantly see me drawing. That's my favorite thing to draw, is because that's exactly what we want to see. We want to see price go up. We want to see it pull back. We want to see price take out the old high, pull back. Take out the old high, pull back.
Hey,
That's how we know price trending.
so the price got to just tap into the TP, or do it got to close in the TP?
With TP or tap, like shit, damn near,
Yeah, yeah.
yeah. Cause shit, you wait for
Like,
that
it take
motherfucking
is a tap.
close. Yeah, you wait for that close, you will have candles like let's see. You'll have I'm trying to find a good ass candle. Maybe I should go to like
You like the one we just did?
the hourly where you have a candle like this. If you got out when it went above this previous candle, you know you would have been straight, but it was right here at one point, then it dropped all the way back down to here. So it's
Yeah.
like if you wait on the close of the candle, a lot of times you'll lose profit. In some cases, you might make some more because it closed higher, but a lot of times, like yeah, we just when it hits the profit, the TP or the profit target, that's then where we're deciding that we want to get out.
I thought they were automatic.
What?
It is if you set it up, like if you set
Okay.
your feet, you'll take profit. But like if you watching it and you'll just mark it out on your chart, and when you see it hit it, just get out. But
Okay.
setting it up is gonna be easy because, like you say, all it takes is tap. Like he can literally go up there and tap that bitch and reverse all the way back down, or
You good.
reverse all the way back up, but you would have been out just because this off the tap.
Yeah, 'cause like I could show you example. Let's see. I can show you example from this. I think why I didn't do it. But like I can show you example. I can set a order right here and whenever price get to that order, let me set it a little lower so it'll like whenever price tap that, you see how I'm in there now, like I'm in that trade. And if
Yeah.
I then want to get out of that trade, I just sit it wherever my TP gonna be at, and then it's just gonna automatically go there and then take me out itself. It ain't gonna be nothing like that. Do too much. I gotta do too much thinking on. Like you see, I just automatically took me out wherever I set my TP or my target at, then it's just gonna automatically take you out of the trade. So it ain't like nothing to worry about. Like, yeah, it'd be a pretty smooth process.
Like that sound on my alley.
Yeah.
Especially if you're busy and not looking at that motherfucker.
Yeah.
If you busy or short minded,
Yeah. But that's one of the things most time if you finna walk away from them charts, don't leave no trade open.
Yeah,
And
without no stop loss
without
or
no
TP.
stop loss or TP, because you'll come back heartbroken. Price will be to hit your TP, you come back and now price in a whole nother place.
like I bought some money.
Like so it's like
Far
yeah,
away from that motherfucker.
yeah. But yeah, like that like I said, the process that we really use is pretty straightforward. Like we looking for liquidity sweeps. And then after we see those liquidity sweeps, we want to then see price reversing. And then we want to catch the trend. And then once we're able to catch that trend, then, now we just want to see can we ride that trend and continue riding that trend. Because even on this downtrend here, like, let's see, like this high right here, it swept out. It swept out all of this liquidity over here. It swept out all of this liquidity. Then after it swept that liquidity, what do we get? We got a market structure shift.
You
We
see,
got a
okay.
market structure shift.
A bearish one though.
Yeah, a bearish market structure shift. And then we tap back into
I'm
this. Did we
crazy.
tap? We barely tapped back into this fair value gap. We barely did, but we did tap back into there, even if you wanted to use
Hey,
this one.
is there not a fair value gap above it too though?
Yeah,
Or it ain't gonna matter?
it is a fair value gap above it
Okay.
also. And a
So
lot of times
okay.
when you have a fair value gap above it, you can combine them and you can make it as one. So
Okay.
cause if it is two, you got to treat it like one. So you give it room to go up into the second one also. But you see like how after we get that market structure shift, how price tapped into that fair value gap,
Yeah.
then it went lower. So it's like, we tapped into there, we tapped into
Like the script.
internal. and then we
What the
tapped
fuck?
into external. So it's like you will see this. This is something that you can see happen a lot on your charts, is how price can move from internal to external. And that's the price that we're trying to catch, or that's the price that is easiest to catch. A lot of times, if you see price like this, like how this price, like in throughout here, you don't see any fair value gaps. Like
Mm-hmm.
you don't see no fair value gaps. So there's
Oh,
times where it's like it's two things you can do. Either you can drop down to a lower time frame, or either you can just be like, oh, I don't know if I don't want to trade this because I'm not seeing my normal cues that let me know it's time to trade. I'm not
okay.
seeing that internal to external.
Okay. Hey, bro. So you saying basically you would be what you just said? That'll be your thought process if you were like this was the live time and the future shit ain't happen yet, right?
Yeah, if the future stuff ain't happened yet, and this is just what I'm seeing now, like if this was the
Okay.
live stuff I'm
Current.
seeing, yeah, if it's current, and I'm not
Okay.
seeing that smooth internal to external, or I'm not even like, and throughout this price, you don't even see a fair value gap get created, then it's like, I don't even want to be dealing with that price. So it's like I'm just gonna log off the screen. What I want to see is price like this, where we have these moves where fair value gaps are getting put in, or price like this where you see fair value gaps being put in, or like this where fair value gaps are being put in, or here where you see this fair value gap put in and price reacts to it. You see like the difference in how price moves kind of straight up and pulls back when you have the fair value gaps involved. And when you see no fair value gaps, it kind of moves clunky and sideways.
Yeah.
So it's like you kind of want to stay away from that. But sometimes throughout, when it looks ugly and clunky, you can drop down to another time frame. So like right now, we'll drop down to that hourly, and we can see it looks a little better, but it still don't look the best. So like we can try the 15 minute. So a lot of times when you do drop down time frames, it will give you a little bit better clarity, or sometimes the candles can clean up. And like you see here, it looked this super ugly on that 4 hour, that hourly. This 15 minute don't look the best either, but it looks better. Like you now you're seeing your fair value gaps, and you seeing price tap into a fair value gap here, go and take out that swing high, pull back, tap into the fair value gap here, and then price tap into it again here, then price go higher. So a lot of times if price is looking clunky on the higher time frames, you can move down to lower time frames, but it's pros and cons to that, because on the lower time frames, a lot of times you can mostly always find a setup on the lower time frame, but you're more susceptible to fake outs on those lower time frames. The
Mm.
higher time frames are way stronger. And it's just like, if you see something every day, or you have access to something every day or so much, it becomes less valuable. So these smaller time frames setups are just spitting out every, on the 1 minute, each candle comes out 1 minute. So you can have setups every so often. On this 4 hour, each candle takes 4 hours to form, so you're going to see less candles form throughout one day. Throughout one day with this, about what you probably see, six candles form, maybe.
Yeah.
You see six candles form, five, six candles form throughout the day. That's not a lot, so it's going to take longer for these setups to form. So the higher the time frame, the more you'll be able to trust the setup, because it's taking longer to form. They're not just spitting out.
I got a question. Um, I already asked this, but I need to ask again. You taking the trade like whatever for whatever time frame you in, or everybody taking the same trade? If that makes sense.
What you
Like
mean?
like if you take a trade on a 5 minute time frame, you like your trade like basically it's gonna move faster or slower than you take it on the 15 minute.
Oh
No,
hell no, that bitch
no,
moving.
I've been moving at the same pace as everybody else shit.
It's just a different set of data, I
I
guess. A
mean,
different thing to
yeah,
look at.
yeah, basically.
Yeah. Yeah, just a
Okay.
different, yeah, there's a different data set that you're working with. But the way that price move is controlled. Like, I don't even know how they used to do it in math, but the control variable, like the way price moves, it's gonna move the exact same on each time frame. Like how this
Okay.
price is at 25,077.25. This right here is not going to change no matter what time frame I go to. No matter if I go to the 5 or the 1 minute. If I go to the 1 minute, it's like I'm gonna show you. I'm gonna give you an
Okay.
example. Like this, I'm gonna try and zoom in. This the 4 hour, and this is the 1 minute. This is the 1 minute time frame. This is the exact same chart, by the way. And like you can see how price is moving. This price is moving like it's at the exact same price. If you look right here where it says it's 2574.25, it says that exact same thing right here. So price is moving at the exact same pace. When you see one move, you're gonna see the other move. They not moving without each other. They all time frames are in sync.
Okay.
So when this one go up, this one go up. Like they both gonna go up at the exact same pace. Like they, and then if one go down, they gonna go down at the exact same pace. It's just these candles it's a whole different data set. So it's gonna be way more 5 minute candles. That's the only difference. It take 5 minutes for this candle to form, and then it takes 4 hours for this candle to form. But it's still gonna be price, still gonna be price. It's just the amount of data that the amount of data that you have in a given time.
Yeah, the higher time frames hold more weight. And what I was talking about earlier, it didn't like you just said, that bitch didn't touch the fair value gap. It got close to it, but where London High stopped at and where New York, where we would have took profits on that trade on the hour, it was an hour and a 4 hour gap.
Yeah,
It
and I
stopped
think
literally right up under that bitch. But that's what I'm saying. We've been fighting that motherfucker. I know for 3 weeks.
yeah, and I know even when we went over today, like even the internal, external brings up more questions for you because I know another question you might have is okay, now you still thinking what the hell is going on, with the time frames. Like, why would I need the 4 hour? Why would I need the hourly? Why would I need this, these certain time frames? And we're gonna go over why you need each time frame. It's called like time frame pairing. So, like to just give you a good example, is when we look like if we look for our internal to external on one time frame. So like let's say we on this hourly right now, and we're looking for our internal to external on one time frame, then it will be a smaller time frame that we will go to execute on. So that's basically saying we're looking for our trend on one time frame, and then we want to execute on another time frame.
On the smaller one.
Yeah, on the smaller one, because those small, like when now we have the trend and we have where we see the market going. Now we want to execute on this smaller time frame because these candles print faster and they'll give us a better, faster entry to be able to go where price is still going to go on the higher time frame. Like no matter we enter on the
Okay.
lower or not, this price is still finna go up to here on this higher time frame. So we just using that lower time frame to get a quicker, better, more precise entry. Because if we enter on the lower time frame, we can enter inside of this 1 hour candle, which will be, within some 5 minute candles, we'll be able to enter here if we break down this 1 hour candle. But if we just stick to this hourly, and we go off of the market structure shift here, now our entry is all the way up here because we had to wait for a hourly internal to external to happen and tap in here, when we can go down to the 5 minute or something and then find
Yeah.
a entry inside of here, and now we get a way better entry lower, and we get to ride more of price by getting that lower entry than having to wait for it all to happen on this higher time frame. But the higher time frame is very important because this is where we really ride the trend. We just using that lower time frame to get a quicker,
You get
better
him a little
entry.
better.
Yeah.
And like I said, I think the Asian dude, the video he's told me to watch. I think that's what he's talking about.
Yeah. Yeah, Kyle.
Boy, you got into it tonight. And like you been holding it back. Hold back the good stuff.
Got to sometime.
Yeah.
You been too excited.
Yeah, that's why I be telling nigga. I was telling them nigga ask the question. I'm like, damn, bro, I want to tell y'all niggas so bad,
Yeah,
but
hold on.
I wanted to, but like, I could get to spitting so much out there, but it'll be overwhelming if I just told you everything in one day. Like, of course, your mind want to know everything, but
Don't
if I
need to
just,
though.
yeah, but if I spit everything one day, now you confused now at this. So it's like it'd be better when you learn. Then as you learning, most times a trader who is learning, the same question gonna come up for everybody, and then it's like, okay, that's where we gonna move. And that's like how the lessons are tailored to. You learn this, you have some questions, you're gonna have some questions about it. That's the next thing that we going into. Cause like one of the next things that we go into, like we'll go into after, but like I like to make sure that you get it first. But one of the next things that we'll go into is some called market maker models, and that's gonna basically explain to you the really the time frame pair and then how you can also look at the market and kind of gauge where it's going, even with the external to internal. Because like, yeah, you understand that the market moves from internal to external, but like, where will the internal to external stop, and then where will it reverse and go the other way? So it's like that's something that we'll be implementing too. It's like all of it, everything feeds off of each other. But like everybody been saying though, make sure you putting that screen time in
I'm
and
still
doing something on your chart. Like you making sure you understand your swing points, making sure you put in some work with the internal to external. Because like I said, without that screen time, it's easy to learn something then just forget it. But once you put in that screen time in, you won't be able to forget it because you working your brain, you getting on there and you actually learning it and you're doing it, you're interacting with it, so you're not gonna easily forget it. It's easily forget something you watched the video on or somebody showed you, but once you go and implement it, it hit a little different.
No, for real. Oh yeah, bro. We bull.
we bull.
I was like, that what you on? That's how you feeling.
Nah, that's